Good afternoon, everyone. Thank you, Friedrich, for that very good scene-setting session. And thank you also for not introducing me as the bad guy. I'm glad it's someone else on the panel. I'm very pleased to be with all of you here today to discuss the base erosion and profit shifting project. I don't know how much you all know about it, but I thought given the topic that we have and the different perspectives we have on our panel that maybe I'd go through first and give you a little bit of scene setting, starting with what is BEPS. And so here, I think in this picture, you can see pretty clearly what we're talking about. We're not talking about all of the international tax rules, but what our project is really focused on is the situation where you have profit-shifting strategies that are not associated with real investment and economic activity. You have the business activity, whether it's R&D or sales or manufacturing, in one country, but all the profits are in another country and in a country that had nothing to do with generating those profits. I think that's probably the simplest way to explain this. Now, many of you may be saying, well, this is not new. So why are we focusing on this now? Well, certainly the economic crisis had an impact on this, and governments certainly needed money, so they needed to focus on restoring revenues so that they could also restore growth. But that's not really the only reason that this issue has come to the fore at this time. So first we have changing business models. If you think back to the 80s, for those of you who were working in the 80s, you had very highly decentralized, country-specific models incorporating an entire production cycle. Now you have very centralized and vertically integrated business models where various stages of production occur across a whole range of countries. So we're talking about global value chains and very disaggregated activities, but very centrally controlled. The other thing that you have that has changed is the increasing importance of intangibles and also services, both being very highly mobile activities. And so these features have really exacerbated the changes that we see in business models and how profits are generated. This was also exacerbated as a result of the digital economy. And so now we have a very different economy from what we had before. And can you really compare traditional retailing activities with online retailing activities? In traditional retailing activities, you had a situation where basically you had the company having a physical interaction with the customers, with the market, and with the seller. Now, in a digital economy, you don't necessarily have that. And you can sell products, digital products, that are not physical without having a physical presence or a physical interaction with the market or the customer. And so in that context, are the current international tax rules really still fit for purpose? And that's really what we're talking about. I know some people think that our project is an anti-business project, but it's not. What we're really trying to do is to bring the international tax rules into the 21st century. If you think back, for those who are familiar with the OECD, when we first started our work, which basically predated the OECD with the League of Nations, what was it that we were trying to achieve in international taxation? Our main focus was to eliminate cross-border tax barriers to trade and investment. And so that has been the basic focus of our work, and you see that reflected in our Model Tax Convention, which has been used for the negotiation of over 3,000 bilateral tax treaties, and also in our transfer pricing guidelines, which try to set out the rules for cross-border business activities within a single enterprise. But these rules really, the core of them, obviously we've updated them over the years, but the core principles were set over 100 years ago, and at a time when you had basically brick and mortar businesses, and when you had a situation where you had a product designed, developed in one country and sold to another country or other countries. Very simple cross-border model. Well, all of that has changed. Now, as I said, the economic crisis certainly had a lot to do with this, but these other factors have really driven us to this situation. Why? Because what has happened? As a result of the rules not having kept pace with the changing business models and the different ways that the economy has developed, we have now a situation where the gaps either between countries' national tax rules or the loopholes within the international tax system can be exploited to separate profits from the economic activities that were generating them and putting a lot of profits in places that have little or no tax. Now, this was perceived and is perceived as very unfair, not only to purely domestic companies that are competing with these multinationals, but also vis-a-vis individuals. Because what happened during the economic crisis? Well, governments, in trying to bring in revenues, but at the same time stimulate the economy, did two things. They basically lowered corporate income tax rates to spur growth, but also because they needed revenues, they often raised personal income tax rates, increased value-added taxes, and also increased property taxes. All of those latter taxes having a big impact on individuals and small enterprises. And so the sense of unfairness became blown into a very, very big issue, which led to a lot of people focusing on this in the media, and you've all seen these headlines, GE, Amazon, Google, you name the big company, and how they are able to legally, as Friedrich said, get away with paying almost nothing in corporate tax. Now, this has led to a lot of outcry, and as Friedrich also mentioned, there have been hearings in parliaments around the world, not just in the UK, but in Australia and the US, all over, looking at this issue and looking at it very much from an unfairness perspective. And I think the other thing that they've been looking at is trying to look at the data showing that there are distortions in the economy. For example, did you know that the second largest investor in China is the British Virgin Islands? That's a little strange. The largest investor in India is not the US, the UK, or any other country, it's Mauritius. So a lot of people were saying, what is wrong with this picture? And all of this attention was finally absorbed by political leaders, and the G20 in 2012 asked the OECD to focus on this issue and come up with solutions to tax base erosion and profit shifting. And so in 2013, we published a report setting out, because they didn't give us a lot of time, they said this in September and asked us for a report in February. So we published a report setting out what are the issues, what are the strategies that are being used, what are the loopholes that are being exploited, and then subsequently we published a 15-point action plan in July of 2013. And this action plan essentially focuses on restoring coherence of corporate tax at the international level, realigning taxation with the substance, that is to say the activities that are generating the profits, and then also to improve transparency, which will bring greater certainty and predictability to the tax system. Now, we also, because there was so much focus on the digital economy, we also wrote a report about the digital economy. And in the beginning, you may recall, there were many countries calling for a Google tax, because this was a separate, special kind of economy. But having analyzed the economy and looking at what was called the digital economy, we realized that the digital economy is now the economy. That everything is being digitized, whether you're manufacturing trucks, cars, think about all the technology in your motor vehicles, and you will see that you really cannot separate out the digital economy from the mainstream economy. Now, the other thing that we did was we published a report on the feasibility of developing a multilateral instrument that would enable the modification of all those 3,000 bilateral treaties in a single swoop. Why? Because if we are able to come up with agreed principles for changing the international tax rules, we cannot wait another century for these to be implemented via tax treaties. And so we thought if we could come up with a multilateral approach to this, this would certainly accelerate the process. Now, to go into the detail of what the 15 actions are, just so you can get a sense, and I don't have time really to go through all of these, but we have under the coherence column, hybrid mismatch arrangements. Very simply put, this refers to transactions or structures that enable, for example, a company to get 2 deductions for a single transaction. We've now published a report setting out how we can prevent this from happening. We're also doing some work on interest deductions. As you know, using loans and interest to shift profits is one of the most basic ways of reducing taxable income through tax planning schemes. One of the things I want to talk about is what Friedrich referred to, the so-called Lux leaks, the Luxembourg leaks of 28,000 pages of private secret rulings that Luxembourg has given to several hundred companies. Now, rulings per se are not a bad thing, but I think what this shows you, the outcry over these rulings, is that transparency is important. Also, non-discrimination is important, because obviously you can see through some of these rulings that some taxpayers are getting a better tax treatment than others. And so part of our plan, part of the 15-point action plan, is to try and deal with these sorts of things. So how are we going to deal with rulings? Well, first, in our Action 5 on harmful tax practices, we are requiring the spontaneous exchange of information about rulings from the country that is giving the ruling to the country where the other part of the transaction occurs. And so that's already one big step in transparency vis-a-vis the tax administrations. The other thing that we will be doing, for those of you who have been following this, we have issued a report on transfer pricing documentation, and the transfer pricing documentation has 3 components. First, the requirement for multinationals to establish a master file. Second, to establish a local file, including local information. And third, country-by-country reporting of profits, revenues, employees, etc., to enable countries to better carry out risk assessment. Now, as part of all of this, they are required in the master file to disclose unilateral APAs and rulings. They are required in the local file to provide information about APAs and rulings where the local tax authority is not a party. And then the country-by-country reporting doesn't necessarily require all sorts of reporting on that, because you will have it through the other reporting, but it does give you the very broad picture of how the multinational works, where it works, and where its profits are located, and where the revenue is being reported. So that's just one way that this action plan is going to help deal with some of the base erosion and profit shifting activities. Now, we have a very ambitious timeline. I mentioned some reports that have already been published, and we published 7 reports in September. Now, you could see from this, if you're doing your math and you're all accountants, there's a lot more on here than 15 items. Why? Because we've split up some of the actions into different pieces. And so, for example, even the 7 reports that we put out, 5 of those should be considered as sort of interim reports. Why? Because we want a coherent approach to all of this, and that means that we need to, at the end of all of the work, look at the totality of the work and make sure the different pieces of this project fit together. And so, for example, when we complete the work on interest deductions, that may have an impact on the hybrids part of the project, and we will want to go back and make sure those 2 things fit together. So that's why you see at the bottom the follow-up to the 2014 deliverables that also refers to the fact that we need to flesh out more of the detail on some of these. We've given some very broad principles. We do certainly intend to complete this all, even though many people think this is quite ambitious. But why is it so ambitious in terms of timetable? Well, for two key reasons. One is that we don't want governments to jump ahead and take unilateral measures, because then we will have tax chaos. And a big part of this project is trying to have a coordinated, coherent approach from countries rather than individual countries trying to tackle this each in their own ways, which would create more double taxation. And more problems for business and governments as well. The other thing is that at the end of the day, it will increase certainty for all, because right now, as we're working on this, I'm sure that a lot of you feel there's a lot of uncertainty as to what the rules currently are, because different countries are interpreting them differently, and what those rules might be for your future tax planning. So that is really why we are trying to do this in a very quick fashion. Now here, as I mentioned, are the 7 reports that we provided. I think I've already described the first 2. We produced a report on harmful tax competition. That is the one that covers the issue of the spontaneous exchange of rulings that I referred to. It's also the one that deals with patent boxes, which have also been in the news, and you may have seen that yesterday Germany and the UK announced that they had reached an agreement as to how to determine the substantial activities associated with patent boxes in order to determine whether patent boxes are harmful or not harmful. This is something, and just to be clear, because I suspect there's some confusion out there, the fact that Germany and the UK have agreed doesn't mean that that's the end of the story. This now has to be discussed among a much wider group of countries in our Committee on Fiscal Affairs, but given that it's based very broadly on what was previously discussed in our committee, we foresee that this will be accepted and become the standard that we use in this project. In terms of ambition, we also have very ambitious objectives. We're going to, as you can see here on the slide, try to restore source taxation through the prevention of artificial avoidance of a taxable presence in a market country. We have, as part of our project, and I haven't mentioned it, but it was on the previous slide, limiting treaty abuse, and we have established in one of our reports a minimum standard so that all countries will have to include in their treaties a limitation on benefits or an anti-abuse rule to prevent the abuse of treaties. We're also trying to restore residence taxation through effective CFC rules. That work is currently underway. We haven't produced a report. That is expected in September of 2015. And then I think you see restoring both residence and source taxation. We'll be doing that through tackling hybrid mismatch arrangements. There we have established a rule to ensure that at least one country gets the tax. We have a primary rule and a secondary rule, so the rules can no longer be gamed. And we are doing a number of the actions relate to transfer pricing. I already mentioned the transfer pricing documentation, but we're also working on intangibles, risk, and recharacterization, and we put out a preliminary report on intangibles. We're still working on the risk and recharacterization. Now, last but not least is the issue of improved dispute resolution mechanisms. You probably are all aware that disputes are increasing. Why? Partly because of uncertainty, partly because of countries taking, shall we say, some creative interpretations of rules that they currently don't like the outcome of. Hopefully, when we fix the rules, then everybody will be applying the rules in the same way. We also have a lot of aggressive tax planning, but just more generally, we have a lot more cross-border transactions than we've ever had before. And so for us, it's a very key priority to try and improve the dispute resolution mechanisms. Now, I want to turn to the issue of developing countries because they have a key stake in this. Now, some initially were saying, well, are these really the most important issues for developing countries? But actually, if you look at the percentage of corporate revenue that developing countries get, and here are just some examples, you'll see that corporate tax for multinationals plays a big role. You see Rwanda with the staggering figure of 70% of its tax base coming from multinational enterprises. You see in Nigeria that MNEs represent 88% of the tax base. In Peru, you have related party transactions, so transfer pricing issues accounting for 26% of GDP. These are really quite significant figures, and so this issue is quite important to developing countries. Now, as we are speaking today, we are announcing at the OECD a new strengthened relationship with developing countries to bring them directly into the BEPS project. And so shortly, I don't think it's come out quite yet, but at 3 o'clock we're issuing a press release that will indicate that we're bringing more countries directly into our standard setting process. In addition, we're establishing 5 regional networks to enable more countries to express their concerns about BEPS issues, but also BEPS related issues. That is, things that were not in our plan. And we already did an extensive consultation. And for many developing countries, the bigger issues are things like wasteful tax incentives. Countries within the developing world are competing through tax incentives to attract business. And they're having a race to the bottom. They're ending up with contracts with multinationals that they really don't like the outcomes of, but they felt at a certain point in time they had to offer those incentives. So we're working with developing countries to deal with those issues, as well as more basic transfer pricing issues like the lack of comparables and trying to find a solution and easier ways to find comparables for developing countries. And so that's what we're announcing today. In addition, we are also going to be providing more technical assistance and support for developing countries so they are able to give us their views on these issues, and so that we can help take those views and use them to shape the project as we go forward. And this, of course, we're not doing alone. We're obviously doing it with the G20, the World Bank, the other international organizations and donor agencies. So there you have it. I want to just conclude by reiterating that, because we're now going to go into what I think is a very interesting debate about, is there a moral issue here, as Margaret Hodge has posed? Is it an ethical issue? And what is the role of accounting firms? I want to reiterate that this is not an anti-business initiative. It really is to try and get the rules to align with current business reality so there can be greater certainty and predictability in the tax system. Thank you.